Hi, welcome back to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Micheal Shearn. Micheal is the author of The Investment Checklist, The Art of In-Depth Research. He serves on the investment committee of Southwestern University, which oversees the school's $250 million endowment fund. In 2007, he launched the Compound Value Fund, a limited partnership seeking concentrated value investments. Let's ask him 5 good questions. Hi, welcome back. My guest today is Micheal Shearn, author of The Investment Checklist. Micheal, where are we talking to you today?
I'm in Austin, Texas. So
Great. Well, we've got 5 good questions for you. Let's get started.
Okay.
Question number 1. What part of the 10K do you spend the most time with? There's so much information in there. What section do you think that investors maybe aren't paying enough attention to?
Yeah, when I look at a 10K, my goal is, one, to understand what the business does, but I also want to know, how does it make money? So one of the first things we look at is we go to the income tax footnote, and what we want to see is, do they make money? Because under the income tax footnote, it's usually about note 12 or around there. They have a line item called current taxes. And that's the money that they send to the IRS. And so if a company's not making money, they're not going to be on a cash basis. They're not going to be sending any money to the IRS. So that's kind of the first stop in the 10K is to see if they're even making money. Just to give you a historical example, I remember looking at Enron, and looking at that footnote, and it was negative. They were not making any money.
Yeah.
But after that, the other sections, this is something I've learned recently, is the risk section, because it's really, if you think of like pharmaceutical drugs and they're funny commercials where they're always talking about, all the risks and things that can happen to you. They're pretty much, disclosing a full amount of things that can happen. The same thing happens in the 10K under the risk section. And what happens is it's very easy to gloss over those risks because they're written in very plain language. And so it's very important to kind of spend a lot of time there because every company that has failed or had a problem, the problem has been in the risk section. It's always in there. But what happens is, again, the language is written in such a way where it's not very alarming and it's kind of innocuous language. But what we try to do is we look at the risk, we read it, and we try to understand, has this company encountered this risk before? Is there a historical example that we can look to see kind of how that risk affects the company? Or is this something that we don't know how it's going to affect the company? So we were recently looking at a company called FXCM, kind of hit our screen, so to speak. And, it was as we were reading articles about what was going on as a company whose stock price had dropped quite a bit. They talked about exactly an article referenced one of the risks in there that that they had to make up the client equity accounts if they ever got negative. But when we went to go read the footnote, it was very innocuous. It was just kind of like, well, it was written in such a way that it was very difficult to catch. So I think, for me, I've learned to really pay attention to the risk section because it really gives you a good insight into what can go wrong. And, you can do your worst case scenarios and things like that.
Huh, that's a good idea. Yeah, I mean, who's going to know their risk better than the theoretically CEOs that are writing it?
Yeah, and the lawyer, they make sure they cover all of them, just like the pharmaceutical industry. Your hair might not drop off when you're trying a certain drug, but it could for some people. So, you kind of have to weigh those things on which ones are real big risks and which are not. But I'd say it's the first part, not the second part about, stocks fluctuating and things like that. It's more the business risk section.
Right. So your book, for question number 2, your book is really all about checklists and in improving the investment process. And that was, all the rage a few years ago when the Checklist Manifesto came out. And so your book was totally on point with all of that and even deeper dive into it from the investing standpoint. Just out of curiosity, a quick question. How many checklist items do you have for your personal investment checklist?
That's a good. I look at a checklist more as a research process. What it allows us to do. It's a series of questions that allows us to examine the business from a lot of different perspectives. So we're not looking at it. In the past, I would just spend a lot of time just focusing on whether a company had a competitive advantage, and I'd ignore things like the customer side or the management side, and just kind of on that one thing. So the questions really kind of help you get a holistic view of a business. But really, the goal of it and the goal of the questions is you kind of want to understand what the distribution of the cash flows are for a business. So are they narrow or are they wide? So there's questions in there like, does it have a high fixed cost base? That would tell you that it has a wide range. So you would know the earnings would fluctuate quite a bit. So it's kind of, as far as number of questions, it really becomes kind of a judgment call. So for certain companies, for example, let's think of FactSet, a service that I subscribe to. I'm not going to be really asking a lot of questions about their suppliers, but if I was looking at a metals recycler, well, suppliers are very important, because they're recycling metal, and so the supply of the metal is very important on where they can get aluminum and to turn into steel. So the questions kind of are weighed depending on the company. But I will say there's two questions that I think must be answered, for us at least, for every company. And I think they carry a lot of the weight. And the first question is, how dependent are the customers on the product or the service? So that lets there's like, say, a restaurant. We're not all dependent on a restaurant. But it allows you to kind of understand the degree to which those cash flows are going to vary. Because if customers are stuck to your product, you're going to have kind of that more narrow distribution of cash flows and less surprises. But if your customers are not as dependent, they can use other areas, then that there's going to be a lot more variation, and so you can prepare in advance for that. Second question is we always like to know who we're partnered with. In management, as we've evolved in our investment strategy, we have learned to us it's really the most important component. So we spend a lot of time answering that question as well. But the number of questions is not so much the importance, but it's just the quality of the questions, and then kind of having that analytical judgment on which questions are important for a particular company. So if you're worried about the CEO and that they're very aggressive in their accounting, well, you would spend a lot of time on the accounting side. We just generally pass on those kind of companies, but say you're a value investor and you look at all different kinds of companies. You would have to spend a lot of time on adjusting the financial statements to make sure to see what they're really earning, because they've been aggressive in their accounting. Right. So it's really it just kind of depends on the company. I hope that answers your question.
No, I think it's a good segue to question number 3, and the subtitle of your book is The Art of In-Depth Research, and it really struck me while I was reading your book that the real art involved is a lot of these little adjustments that you can make to the numbers that you're looking at when you're performing your analysis to normalize things, to get some kind of an idea of to approach what is happening in the real world, like economically versus the accounting.
Yeah.
Other than just the obvious, be conservative or, find a margin of safety, do you have any overarching tips for us on how to make analytical adjustments?
You need to unfortunately have an accounting background, I think, a lot of times to understand. Like I said, we now that we focus on good management, we don't have to make that many, so it kind of gets rid of that whole section. But the difficulty becomes, you kind of go through each footnote and you want to gauge the degree of are they capitalizing a lot of costs? That's an insight into management itself. So we kind of go through the footnotes to kind of understand if they're using the more conservative methods or not, to give us kind of an insight into the company. But then you have, great management teams that are reporting everything, but they're growing very quickly. And so these are the companies where, like Whole Foods is a perfect example. When I first started investing in Whole Foods, if you would have looked it up on the screen, it was trading for, I believe it was anywhere from 40 to 100 times earnings.
Yeah.
And the reality was what was going on is the earnings were being masked by the super hyper growth that they were going through at that period of time. So they were reinvesting a lot of cash flow into the business and a lot of the earnings. And so it was really masking the true earnings power of the business. And so we had to make adjustments. We kind of think about, what happens if they stop growing? What is the earnings? And I remember the figure came out to, it was like 10 times earnings.
Yeah, much more reasonable.
Yeah, more reasonable. But the other thing we look at, and I think it's very important, we like to kind of break out the financial statement costs into fixed and variable costs. So we kind of like to really understand, like, what are the costs they really cannot decrease, like leases, if you're looking at a retailer, like store leases, and what is variable. And sometimes a lot of people think like sales and marketing is variable, but it's not. Like I am invested in a for-profit education company called Strayer,
Yeah.
and they spend about $80 million a year on marketing, and it's a variable cost. They don't have to put out radio ads and TV ads, but it would be detrimental. So it's kind of figuring out, what is this baseline, and going through each line item, kind of understanding, and the notes help you a lot. So, we'll look at they'll break out advertising expense. So you'll see SG&A, and then on your spreadsheet right under that little subcategory, you can put in advertising, the store leases, the salaries of the top executive officers. And so it really gives you good insight, I think, into understanding how, this business and how much latitude they have in their cost structure. Right. Which is under the control of management. So I hope that answers your question. But yeah.
Yeah, basically how many of those costs, if they were really hard up against it, could they strip out and still maintain that same level of revenue?
Correct. Yes. Yeah. Yeah.
Great. So let's transition to question number 4. And this is one of I think the biggest problems to solve as an investor in a person doing research is, there's 40,000 stocks roughly in the world. Yeah. You don't have a time to be an expert on every single one of them. How do you go about narrowing down your universe to screening for the ones where you think are going to give you the best bang for your research buck, so to speak?
Yeah, that's a good question. We've spent, so I'll give you a little historical background. Our universe was more like 9,000 stocks that when we first started into this project, but basically that's U.S. and Canadian stocks. There's a lot of pink sheet companies, in that 40,000 number, so you can really strip out quite a bit of those. But a long time ago, we actually went A through Z, or 1-800 contacts through Zebra and whatever was the last one, and just kind of quickly read the 10K. You can actually get through a lot of companies pretty quickly. And see if we could understand what it was. So if it was a bank or if it was a biotech, for us, we would just kind of pass on it. Or if it was a company that took me a long time to understand what they did from the 10K or the shareholder letter, I would pass on it. So we kind of created this spreadsheet of an inventory, per se, of companies that kind of, we thought we could understand and eliminate companies that we should really not have any business analyzing. And later, as we started adopting our management orientation, what we did is we're able to, there's a service called the 10kwizard.com. And what it does is it goes through all the 10Ks and you can put in search terms. And so we like founder-led businesses. So we could just put the search term founder in there. And I think it spewed out about 1,200 companies from the US and Canada. And so it's just kind of going, now we're even narrowing our universe even more and more. And trying to create kind of this inventory of this is, our universe. This is what we should be looking at. We look at IPOs coming onto the market, spinoffs, bankruptcies that are reorganizing and coming back. So stocks coming back onto the market in some form or fashion. We look at, and we kind of have this filter. We have a criteria of what we like, and it's a certain type of management team, and we add it to the inventory. Now, once it's in the inventory, there's maybe 1,200 stocks in that or 1,300 right now. We like to separate that between what we call our dream team of companies that we would love to own. For example, Container Store just IPO'd. Stock's been down since it's IPO'd, but it's a company that I very much want to own, but at the right price.
Sure.
And so, and then I also use FactSet within the spreadsheet, and it kind of updates us on the enterprise value to sales and enterprise value to EBITDA of different companies. So I'll literally just kind of go down my list within that inventory and see, what's trading at a low price. And that's how I can organize my research time. The only downside, I found EV to sales, by the way, to be the best one because, EV to EBITDA or, the numbers could be much like the Whole Foods example, could be under earning and, you might not capture that. But the only downside to EV to sales is the fast growing companies, the ones that are trading at, say, 2 or 3 or 5 times EV to sales. You would automatically dismiss them as kind of overvalued. But if they're so, we just take a lot of time going through each company and trying to understand it, where it is, and really try to separate that inventory between, okay, this is our dream team, this is what we want to own, and we wait for bad news. There's always bad news. Like I said, in the Container Store, they've missed guidance, I think 3 or 4 times. CEO Kip Tindall, who we think a lot of, finally said no more guidance. So, it's one that it's now getting within the range of something we've been very interested to invest in. So that's kind of how we went about it. It was time consuming, but, it's paid off where it really helps us focus on companies that meet our criteria, because it's so easy in this business to get distracted with companies that don't meet the criteria because they're very cheap. In fact, this year I made a mistake of investing in a company called Body Central. It is a company I had no business in, but, it got so cheap, I got very interested in. So it's really important to kind of, filter out that noise and say, look, I don't have an advantage in this, but I do in this area, and kind of stay there. And it takes time, but, like I said, you could do search terms. In 10K Wizard as a start, you don't have to go like we did through the list of companies that were out there. But, international companies, by the way, we've developed contacts or friends, or we read, see if we read an article of what we like, of somebody who says the right things, is talking about taking a long-term view versus a short-term, we'll automatically add it to the inventory. So we have this robust inventory that we look at.
That's interesting. So it's kind of a good segue too to question number 5, and this has to do with, if you think about investing like a horse race, where it's a paramutual betting, basically. Like, so you don't always have to know who's the fastest horse necessarily, but it's the odds of winning versus the payout. I feel like your book gave an amazing insight into picking the fastest horse, a great checklist of all the different things that make up for a great business to buy. But I'd like to hear a little bit about how the price factors in that, in context of like horse betting, where it's not just about the fastest horse.
You're talking about value, like not just buying, like, say, a Container Store when that IPOs and it's at 30, like waiting for the right price.
Right, exactly.
Is that correct? This is the most difficult thing. And I used to think I was very good at buying cheap stocks. And over time, I've learned that you really get these few opportunities to invest in these great companies. So what we like to do is we kind of divide, give you a little background, like investments between, the way we think about value is this way. So we look at companies as either compound machines, and these are businesses that have the ability to reinvest their cash flows into the business at high rates of return. And for example, one stock like that in my portfolio right now is Brookfield Asset Management. And so in the case of a Brookfield, you can pay up more because over time they keep getting into new asset classes. They have this tremendous growth ramp ahead of them that they're able to reinvest cash flow in a lot of opportunities. And so, in other words, the earnings keep rising in lockstep with the stock price. So that's the ideal company that we look at, something we don't have to sell. We can hold it for a long period of time. They're very hard to find. Another stock we've invested in is called Rally Software, the same thing. They're reinvesting their cash flows into sales and marketing, growing within corporations in the enterprise market. So they have that ability. But that's the ideal investment scenario. And in those scenarios, if you end up overpaying, you end up okay, over time, because that growth, usually will surprise you on the upside. So we started buying Brookfield at 15. The stock today is at 50. But the earnings during that time have kind of kept up in lot. It's a little overvalued right now on existing cash flows and earnings, but it's something that, we can keep on owning this thing because it's going to keep rising. On the alternative end, what we call opportunistic investments these are kind of high cash flow businesses that no longer have growth. And an example of a company we recently invested in is Aeropostale. And in those businesses, we have to get a bigger discount to value because, or even let's use FactSet also as an example. If it's trading at 20 times earnings, FactSet's a business that just throws off tons of cash. They do not have the ability to reinvest that cash and earn a high rate of return. They kind of just throws it off. So we would want to, pay a lower price, and we may never be able to buy FactSet because of this, but the way we're going to get our return, our investment return, is by buying FactSet at a cheap price, not buying it at 20 times earnings. So Aeropostale is the same way. It's a very mature retailer.
Right.
And, we've been investing at that at an enterprise value to sales of about 16%, a very low valuation. But again, there's not a lot of growth. In fact, they're shrinking, which is a good thing. But it's in that case, you have to demand this larger discount for that type of investment. And then there's some in between, that kind of have growth characteristics, and so you can kind of pay in between that. But we generally, that's kind of how we try to separate, our thinking about valuations and what we should pay for an investment, and divide it into those two universes.
Well, that's great. Those are our 5 questions, but we always ask a bonus question, and this has to do with a book recommendation.
Yeah.
And we're always looking for something that is hopefully a little more obscure, that either you really enjoyed or that you found is kind of underrepresented out there.
Yeah. So you'd kind of given me a little heads up on this. So I actually bought 3 copies on Amazon. You can't buy this book. But I define a great book as one where I underline, a lot of stuff.
Yeah.
And one of the best books I've read is called The Man from Zara. I believe that's the correct title. And it's about Amancio Ortega, who is the founder of Inditex, which owns Zara, which is the largest retail chain. And I believe he's 3rd, 4th, I forget it, billionaire rankings. I'm up there with Buffett and Gates. And it's a great book on business, and just a business philosophy. Gives you great examples of how this guy in Spain, was able to create this $1 billion enterprise. And really, it's been a relatively short period of time, just this great compounder. But it's full of, it's a really good story about him. He's a very low key, he's not in the media a lot. There's been a few articles about him in the recent years, but it's a really great insight, and I think it's a gem. I really do. As far as it's a book that I ended up almost underlining half the book in that case. So yeah, I think it's The Man from Zara. But yeah.
Well, that's great. Hey, Michael, we really appreciate you coming on and taking the time out of your day.
Thanks, Jake.